After a surge in August, sales of new vehicles slowed down last month with growth of just about 16.5% year-on-year. Month on month, there was a 9.5% fall in sales to just under 42,000 units. Joining me with more on the sector are Sydney Soundy. He's Managing Executive at Absa Vehicle and Asset Finance. Also Andrew Kirby, Vice President for Sales and Marketing at Toyota South Africa. Gents, thanks very much for coming in today. Sydney, you were in a month ago and we talked really about those August numbers. They had been boosted by preemptive selling ahead of that vehicle emissions tax. So how did they hold up given that preemptive selling in August?
I think, as you indicate, August was, as I call it, an anomalous month. So was September because of a number of factors. As you indicate, August was highly impacted by the preemptive buying as a result of emissions tax. September was largely impacted by the strikes. So they actually cancelled each other. If you look at the average units sold for both August and September, compare that to July and June, there has been an increase. And that's why you see a year-to-date increase of 24%.
Of course, 24% year-to-date. Andrew, how are you seeing sales at the moment? How have they been picking up for you, and where do you see them going from here?
I think we're actually quite encouraged by the September results. If you take into account what Sydney was saying, preemptive buying and the strike situation, the numbers are actually very healthy. So we've continued to see fairly robust sales even post-World Cup. And in fact, I think our forecast for the year has now actually been raised, where we think we're going to have a fairly reasonable end to the year as well. So we're very confident in the remaining 4 months of the year.
How about the different categories though, Andrew? Because I see that light commercial sales down 8% month on month, but year-to-date still up 11.4%. Medium commercials year-to-date up 12.4%. So it looks like it's really across the board that we are seeing this momentum maintained.
The market's definitely been driven by the passenger car segment, and it's definitely been driven by the affordable segments within that. So the more affordably priced passenger cars. The light commercial segment last month was very hard hit by the strikes. We have a good percentage of our vehicles available in South Africa in the light commercial segment that are locally produced. And of course we lost significant volumes there. The medium commercials I think is quite encouraging, because what we're starting to see is some infrastructure spend that's flowing through into those heavy commercial vehicles now being purchased to support that.
How do you see that picture, Sydney? Because obviously you have business customers as well as retail customers. Are you seeing the same sort of picture with people applying for finance with you?
We're seeing the same trend. On the passenger side, in terms of the personal market, we are still bullish that in the remainder of the year we will see some growth. Obviously not the same as the previous months in terms of month-on-month growth, but optimistic that in terms of the volumes we will see quite a good increase from last year.
And business customer feeling pretty solid at this point or not?
Well, on the small business side, we're not seeing the same. Actually, on the small business side, medium business is not as buoyant as we would have expected.
Exports down 36% month on month. That was for last month. And of course, we had strikes and the likes. Do you think that was the sole reason for that drop in exports? We've also got the rand pretty strong at this stage, which must be hampering exports as well.
The rand is hampering exports, but export business is done on fairly long-term contracts and buying forecasts. So the results really for September are largely results of the strikes. And that's a big concern, because I think it's going to take the motor industry at least 6 to 9 months to recover from this.
Well, if you said the export contracts are done on long-term contracts, does that mean that contracts going into the future could be affected by the strength of the rand at the moment?
Certainly, especially if we look at 2011 and beyond.
How about access to finance? What sorts of applications are you receiving at the moment? And of those applications, how many are you approving?
We're seeing the same number of volumes in terms of applications, but in the last 2 months, intriguingly, we've seen an increase in the quality of the application.
And the quality? Are you getting deposits now?
We are still receiving deposits, but if you look at the risk aspects, when you risk grade an individual, the last 2 months, particularly for us in Absa, we've seen an increase in the quality of the type of customer purchasing. And we think that that has to do with the timing of the purchase, that the more astute customers know when to purchase and to take finance. So from that perspective, we are comfortable. As far as the approval rates are concerned, if you just compare the numbers that we have experienced as Absa between now and last year, we've grown by 40% in terms of approvals. So that is a significant softening of the risk aspects given the situation.
Would you see the same picture, Andrew, that more people buying Toyotas are getting approval or are actually applying for finance to buy a Toyota?
I think certainly consumer confidence seems to be improving. We're seeing a bit of pressure on the replacement cycle. The last 2 years obviously being very, very soft. Now people are starting to come back and start to replace their vehicles. Certainly approval rates on finance applications are on the up, and so that's certainly very encouraging.
How about dealerships? Because we saw quite a consolidation in the dealership sector last year due to the financial crisis. Are they on a more sustainable footing at this point, do you think?
Yes, certainly. I think, you know, from a Toyota perspective, we're on quite a strong footing because of our vehicle car park. But I think from a market point of view, the 22% odd or 24% year-to-date growth has lifted a lot of that pressure, and the dealers are a lot more sustainable now.
Interest rates, we had another interest rate cut in September, and of course that brings to 600 basis points the interest rate cuts we've had in this particular cycle. Do you think that's giving the consumer a bit more confidence? Do you think we could have another interest rate cut which could boost that confidence even further, Sydney?
Look, it's given confidence to the consumer. In terms of cuts, obviously economists are better placed to establish
Well,
that.
I'm sure you're chatting to the economists every day.
In terms of our own estimation is that we don't expect any further cuts in the short term. And as a result, this is the right time. If you look at consumers' advice in terms of interest rates, to peg their financing on fixed rates. Because we are, as you indicate, at the lowest level we've ever been for the past 30 years. The last time we had a prime level of 9.5 was in 1979. And so this is the appropriate time for customers to fix their rates for peace of mind, because as we see it in the long term, the rates will only go up and not down.
What sort of rates would you be tying them into then? Because you're obviously not going to get the same rates that they would on a floating rate.
Obviously, we fix rates on the basis of the risk that we take hedging towards a possible increase, but we're making it such that it's also beneficial for the customer upfront in terms of the risk that they take in fixing the rate, but more importantly because now they can establish their repayment levels on a long-term basis without any fear that
so peace of mind there. We talked about the strike. How's that impacted stock levels perhaps at dealerships, and what sort of contingency measures were perhaps put in place to ensure that stock levels were maintained?
It's been a very difficult one because of course we had two separate strike periods. The first one was the motor manufacturers strike, and then only 8 days later we had the components strike. So while we were trying to recover with overtime and extra weekend work, we immediately hit with a second strike. So stock levels are extremely low across the board on all the locally manufactured
And how quick to build
vehicles.
those back up again, do you think?
It's going to take us, I would say, around 6 months to recover the full volume of this 21 odd day strike period, but we are also concerned that we might have lost some sales because certainly customers won't wait for that period of time. And unfortunately it's played a bit into the hands of the imported products, where we've seen their mix start to strengthen now because of that.